Hello everyone, this is Daily Trade Analysis. I'm here to explain to you what kind of economic indicators can warn of a recession. So this is quite interesting to know if you are into trading and if you are into trading futures and the overall market. So right now we are living in a very tricky situation with inflation, with prices going up, and also with the Fed's raising interest rates to unbelievable levels. So remember, we are pricing in, bonds market are pricing in next year's April to be on 5% interest rates. This is crazy, and that level will remain until September, in which they are pricing in a slow decrease, maybe 25 basis points to the end of the year to finish the year with 475. So be careful because interest rates will continue rising, and this will have an impact, a huge impact on people. People have no idea that we are going to be at those levels and they will feel the pain. So you and me we are in a privileged situation as we are trading the markets. We are in front of every economic event and we are feeling the market the best that we can, and we are trying to profit from it, but the real people out there have no idea what is to come. So with this video I will try to explain these 5 indicators that explain the kind of recession that we are, in my opinion, is coming. And the first one is inverted yield curve. I have been talking a lot about inverted yield curve in my YouTube forecast and recaps. So let's take a look to what that means, because I think it's very interesting to know what it is and what kind of information it can provide. So basically the inverted yield curve is the 10-year yields minus the 2-year yields. So that difference should be above 0 if the 10-year is above the 2-year yields. So right now we are having the inverted yield curve. That means that the 2-year, the short-term yield, is higher than the 10-year, meaning that Fed is raising rates and markets are pricing in a higher yield on the 2 years than in the 10-year. So that kind of inverted yield is showing that a recession is coming because Fed is raising the interest rates in the short term, and in the long term the investors are pricing in a slower growth. So that's why they changed it's inverted curve. So let's go to the charts and you can see that this is the inverted yield curve since April this year. We tapped a level. This is the 0 line. Let's not focus on that one, but in this specific level. So in this specific moment in time, in June, this summer, June, this is when market went to new lows. So in this specific moment, it was tapped, and during early July, it went lower. So in this moment, technically, we were in a recession. We went lower, 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 quite lower, and markets were pulling back and pulling back and pulling back. And the recession fear was increasingly higher. Then we pulled back a little bit, the bull rally that we had in September, and now we are in September, early October, trying to bounce again off this support. This is the current status. W meaning triple support, but we have this level. It doesn't matter the percentage, just the visuals. Until this pivot and this resistance is taken out and the inverted yield curve sees a positive growth towards 0, technically we are with a lot of fear of recession and negative growth. That's the first indicator that I would like to share with you. You can track that with TradingView, with the difference between the 10-year and the 2 years. Right now, the 10-year it was at 4.3, but the 2-year is higher. As you can see, it peaked 4.64%, so that's why the inversion on the curve. Let's talk about the next one. Well, this image shows that often the Fed is hiking short term, and that's why investors are seeking long-term bonds over riskier assets. So this indicator has an average month until recession of 15 months. So obviously, we are not seeing a slow growth. The GDP technically was 2 quarters in the negative, so that's another indicator that shows slower growth and recession is coming. So this is the average, but for sure, we are seeing the inverted yield curve and a slow growth, and that's worrisome. You have to worry about that because the economy will feel the pain in the coming months. Corporate profits. This week's earnings and last week financial earnings is very important for big investors and for corporations to show profits. In the last earnings season, we have an outlook for this quarter of slowly decreasing profits. They decreased the outlook for this session, and I think corporate profits this season are quite nice. Right now, with 1 week and starting this big earnings week for the tech sector, we are at 70% of beats versus misses. So corporations, big tech companies, and big companies are beating expectations. That could be because they lowered expectations in the previous season, or that they are seeing increasing profits, and that's something that you have to think about. We are seeing high in pricing, we are seeing slowly growth, but corporate profits are going higher. Well, that shows you that corporates is not market, it's not the real economy. A lot of people are feeling the pain while corporate profits are making new highs. And you have to differentiate that kind of thought, because if you are trading the market, you want to see corporate profits. You want to see your investments go up. But in this situation, it's quite tricky because corporate profits need to go down for inflation or the Fed to stop hiking. This is something that we need to be very aware. This is a mixed sentiment, and we will see what happens. Because when profit declines, business cut investments and wages, and that's unemployment, and that's exactly what Feds want. They want the inverse. They want employment to be down, unemployment to go high, and wages and money available for people to go low. So that impacts the corporate profits. So that's quite important right now because we are in earnings season, and this is very critical for Fed's decision in the upcoming months. Unemployment. Employment, you need to see unemployment to go high because you are in a recession. So unemployment should go high. If we check the unemployment, we are at the lowest level since months or even years. We're at 3.5%. So employment is super strong, and that's one of the things that Fed is still not seeing going down. We need weakness to start appearing in the employment. We need to see unemployment raise significantly. What else? We have housing. Housing is one of the big sectors, one of the sectors that more impact has on the inflation and the indicators that Fed uses for inflation. Housing is quite important, and declining at least 10% from previous year is called to impact the economy and cause a recession. So if we check the housing starts, this is the, as you can see, we are more or less, we are way lower for sure, and I think that 10% is already in there pricing in the market, but housing is starting to fall. Since April, we are starting to see housing start going lower, and month over month, we are seeing more and more decrease in housing starts. So that's good for the current situation, but again, we are worried about a recession. When the economic outlook is poor, home builders just cut back on housing projects. And the rest that you have to be aware is leading economic indicators. These kind of indicators are very different from trader to trader, from investor to investor, but one of the things I would like to point out is that dollar is very strong right now, and dollar needs to chill. Dollar needs to start weakening for the economy to go up. Strong dollar is affecting other countries' central banks and also affecting the earnings of the corporations and the companies in the US that trade overseas and have products overseas. And obviously, a strong dollar is bad for recession, but it's something very tricky, because you may think that strong dollar is good for you, but if dollar keeps getting expensive, more and more expensive, your money and other countries' money it costs way more to finance and to have payments from those central banks to exports in US, and also more and more your money value is less because dollar is increasing. This dollar index is quite important. What else I'm seeing? I think one of the important things, and I think that's the last one that maybe you are not aware, is sectors, risk on, risk off sectors. Utilities is risk off sector. When big money wants to cover their exposure to the market, they go into defensive sectors, and utilities is one of them, and staples XLP is another one of them. So one of the things that I am looking right now is the ratio between XLY, that's consumer discretionary, versus staples. If this thing goes high, XLY, consumer discretionary, a risk on asset, is going higher, and that means money is flowing to the riskier sectors in the economy. That would imply that money is starting to be put in the riskier assets, and I think people overall sentiment will be more positive, more bullish. And right now it's in the middle of nowhere. We are with a lot of uncertainty in this market, and XLU also, it's more or less bouncing, but it's not starting to push. We can see these moves happening, and these moves are the ones that we want to see to have some correlations with the overall market. Once the defensive sectors are not receiving money anymore, we can see more bullish sentiment in the overall market, because money is flowing to the riskier assets. And I think Russell 2000 is one of the things that you should watch if you think that momentum is starting to catch up. Russell is holding, didn't make any new lows, and is approaching, starting to grow. And when Russell pushes, it pushes the overall market, because big money can start to invest in riskier assets, small caps, and all that. So I think basically this is what I'm watching. This is very important topic for you to understand how the market and the economy works right now, because it's quite tricky to understand that some good things, some good news, sometimes they don't transfer to positive news, but negative news to the market. But remember, markets are not the real economy. Right now, we want more or less to be in a recession, the so-called soft landing from the Feds and from the media. We want to start going to a slow recession to cool down the economy, to beat the inflation, and then we can rebuild the economy. But that goes against corporate profits, employment, and sectors as important as housing and labor market. So that's why we need bad news, and those bad news mean good news for the market. I hope you learned a lot of things today. I'm for sure learning a lot, getting a lot of experience from this market. This kind of market is very unique. A lot of investors that are trading the market for years, for decades, did not see this kind of market. So if you are trading this market, focus and get as much experience as you can, because this is one in a lifetime opportunity for you to learn the bearish market. There's opportunity in both ways, both bullish and bearish sentiment. You can take long, shorts, you can hedge, you can invest in a lot of assets, futures, options, stocks. You have a lot of opportunities in this uncertain time to gain money, to take profits. So don't miss this opportunity. Learn your markets, learn the economy and how everything works, and you'll have the edge for you to be profitable and success in this career. So I appreciate your time, and hopefully I can make more videos about this interest or other topics that you may suggest. But this is quite important one coming into the end of the year, and people may be starting to be too bullish. But we have to wait slowly. In the past, in June, in March, in April, we had a lot of situations in which people thought maybe this is the bottom, but this is not. So these 5 sectors, these 5 indicators are quite good to understand that once they start to align and we are seeing some improvements in these indicators, and I think Fed will start pivoting and decreasing rates. Until then, you want a recession right now. You want bigger, or I don't think big is it's something that we all want, but some kind of recession to cool the economy, it's welcome right now. So thank you for your time, and if you like this video, please, if you found this video useful, please like and subscribe to the channel. As you know, I upload new videos every single day, market forecasts, market updates, and market recaps, and also I try to upload shorts for you to enjoy, some specific short videos, and also these longer ones for big, important, interesting topics as indicators for a recession. So subscribe to the channel, and welcome everyone. See you at noon with the market updates, and stay safe everyone. Remember, discipline and risk management are super important for you, are key for your success. See you later.